Good morning, everyone. We have our Renters' Rights Bill update and the tax update. My name is Greg Suman. I'm the MD of Lettings at Martin Gerald Estate Agents. I'm also the immediate past president of Arla Property Mark, which is the largest trade body for estate agents in the UK. Mitch will be providing a full tax update after my brief introduction to the Renters' Rights. And there will be a Q&A session at the end of both of our presentations, so get your questions ready. Before we start, I'd like to point out that this should not be taken as legal advice, and although I've studied the 250 pages of the Renters' Rights Bill very, very carefully, I don't want to sort of mislead you into thinking that I am a solicitor. However, I have connections to some very high-profile solicitors, and I know where to get the answers if I don't know them. So, without further ado, let's kick off. So, first and foremost, the Renters' Rights Bill is not something that was sprung upon us without any notice. It is largely a rejigged renters reform bill, which was put forward by the previous government as part of their white paper in 2019. And despite that, we've been talking about it for the last 6 years, about 10% of landlords are still unaware of the changes. And a lot of landlords are understandably quite concerned about sort of what this will mean for them, which is one of the reasons why we decided to put on this webinar. As you can imagine, it's impossible to fit everything into a shortish webinar that we've got, but I've done my best to sort of compile a succinct summary of the most important changes that landlords are concerned about. So if you want to read the whole bill, we are happy to forward it to you. You can download it from the government website, but there are 250 pages of it, and I'm afraid to say it's not the most exciting of reads. So if you prefer to get somebody to guide you through it, our fully managed service is the right package for you. I'm happy to speak to you all individually afterwards, so my details will be on the last slide. You can connect with me on LinkedIn, or you can email me directly and I'll come back to you. We can review your portfolio. But one of the things that I want to mention is nothing beats insured rent and legal protection, which comes free of charge with all of our initial tenancies. Because if nothing else, you can be certain that it's going to take longer to evict tenants, and it will likely cost more money as well. So, the bill, one of the most frequent questions I'm asked is this really happening? Can they cancel it? Will they proceed with it? So I can sort of safely say that it is extremely unlikely that the bill will not go through. I think it will go through very quickly now, because it has cross-party support, and whilst they're still hashing out some amendments, it's done most of its journey. So we've seen it go through the House of Commons. We're now at a committee stage in the House of Lords, and then once that's done, we'll get royal assent, and I anticipate the bill to come into effect and become law sometime around September, October time. So, what are the key changes? Since the late 80s, the default position for tenancies in the UK, or in England and Wales specifically, was assured short-hold tenancies. This was changed as part of Housing Act 1988 to make it easier for tenants to get possession of their properties back, because prior to that it was very, very difficult. You might remember, some of you might remember the sitting tenants, and how difficult it would be to sell the property or remarket it, or even sort of increase the rent. So we're not going back to that, but the Renters' Rights Bill will bring an end to short-hold tenancies, replacing them with open-ended periodic tenancies, which give tenants, as the name suggests, more rights. What it means is that where you have a fixed term tenancy right now, since the pandemic, we've seen tenancy terms increase from the standard of 12 months to an average of about 2 years, sometimes as long as 3 years. All of those will become periodic pretty much overnight. This means that landlords will be able to use one of the Section 8 grounds to evict a tenant if they need to, provided they state why, and tenants will be able to give 2 months notice if they want to leave. So essentially the fixed term tenancies will come to an end. But it's not the end of the world, because majority of tenants want to stay longer. If anything, it probably gives landlords a little bit more freedom to do what they need to, notwithstanding that they've got a 3-year tenancy, 2-year tenancy, and so forth. The other big change is that rent increases will have to be done through a Section 13 notice only. Currently, the default position is that rent increases are done by agreement. At the end of a fixed term, landlords and tenants have a conversation, often through agents who represent the landlord, and a new rent is agreed, a fixed term contract is signed until the next review. Alternatively, there are some rent review clauses in tenancy agreements which link it either to the retail price index, consumer price index, basically inflation linked increases every 12 months or so. After the bill becomes law, that will not be possible. The only way to increase rents will be through a Section 13 notice being served, and tenants can appeal that through the first tier tribunal. It's really important to understand that first tier tribunals are free for the tenants and are very time consuming for landlords. So there are mechanisms which we at Martin Jarrod have thought of to reduce the risk of the tenants going to the first tier tribunal, because you can agree a lower rent increase than stated in the Section 13 notice if both parties agree, and that's in writing. So I think the process around the Section 13 notice being served is more important than the actual Section 13 notice being valid. Advance rent payments will be restricted to 1 month. So where previously landlords were able to take 12 months rent in advance, 6 months rent in advance, if a tenant was self-employed or didn't have a perfect credit history or didn't have a guarantor where that was needed, landlords could take advance rental payments to reduce their risk. This new law bans that, and the maximum rent that can be taken in advance is 1 month. The other thing is that before requesting any rent, landlords need to sign and execute a tenancy agreement. So you could be in a position where you've got a live tenancy agreement where the tenant has the right to take possession of the property before any money has cleared in the landlord's account. So for obvious reasons, the risk to landlords increases at that point. But again, there are mechanisms where we can help protect landlords against tenants breaching the tenancy agreement even before the tenancy has started. So ending a tenancy, and you'll notice that I'm addressing this before we address starting new tenancies and advertising. The reason for this is most landlords currently have tenants in situ. They have fixed term contracts, others on periodic tenancies, and one of the questions I'm often asked, what happens if I can't use a Section 21 notice? The government prefers to use a different term for that. They call it no-fault evictions. And of course, most of the time, whilst there's potentially no fault, there is almost always a reason for a landlord to evict a tenant. Now, the government have strengthened Section 8 grounds. They've introduced some new grounds. And although historically Section 21 was seen as the easier way to get the property back, the accelerated possession proceedings route, since the Deregulation Act in 2015, those Section 21 possessions became more and more problematic. And I think most of you who've had experience with the small claims courts will agree that it's become longer and more difficult to get the property back through a Section 21 notice. Most judges are predominantly looking for reasons why they can essentially throw the case out and not enforce that eviction instead. The tenants can always end the tenancy with 2 months' notice from the rent due date, essentially to expire at the end of a period. What that means is the minimum contract that the tenant is signing up for is simply 3 months, because they can't serve notice on the day that the tenancy starts, although in certain cases I suppose they could, but it defeats the object. So naturally, the earliest point that they can leave is after 3 months. So some landlords, again, are concerned about that. Nobody wants to go into the short-term rental market as a result of that. And again, this will need to be given a little bit more thought. One of the things that we will be doing is looking at how long the tenant has been in their previous property, what they do for a living, why they're moving. So essentially qualifying tenants will become more important than it ever has been. Going back to landlords recovering possession, there are still perfectly reasonable ways to get the property back. So for example, if somebody wants to sell a property, you serve a new ground 1A is the amended ground. If somebody wants to sell, ground 1 is where you can move a family member in or move back in yourself. Those notices cannot be served in the first 12 months of occupation, so the tenant has a minimum guaranteed tenure term of at least 12 months. However, if the tenant is in arrears, then ground 8 of Section 8 can be served and possession recovered under that route. The problem is how long it will take. So although there are mechanisms to do that, landlords need to think how they're going to protect their investment, and the best way to do that is through a rent and legal protection service that we offer, which guarantees the rent to be paid until the tenant is evicted. I think the risks have increased significantly since the bill was put forward. So even those landlords who didn't previously think that rent and legal protection is important to them are now asking those questions, and I think that that's very right to do so. Antisocial behaviour and various other grounds are still mandatory. For example, a right to rent expiring can bring the tenancy to an end very quickly. Antisocial behaviour does so too. The problem with the antisocial behaviour clause is you need to prove it, and without clear evidence, it might be difficult to do so. So ending a tenancy is changing, but again, nothing to be overly concerned about, provided you're getting the right advice and know what you're doing. When you get the property back, you will probably need to find a new tenant. And the changes in advertising and lettings practices are also changing. The advertisement needs to be transparent and must specify a maximum asking rent. The government heard that tenants were entering bidding wars and almost auction style, where rents achieved were going above asking price by a considerable margin. That was true shortly after the pandemic, when people were sort of moving back to London, demand increased, supply shrunk, and we saw rents skyrocket. At one point, I remember putting a 2-bedroom property on the market, and we had in excess of 200 inquiries on that property within 24 hours. Naturally, the property went for more than the asking price, but it's rarely seen now. The market has softened a little bit, stabilized, and although it's not a problem now, I think the government are preempting the effects and unintended consequences of this bill, and I anticipate that towards autumn and into 2026, we will see rents increase quite significantly again. So essentially, you'll advertise the rent and the tenant will be able to bid up to that rental amount. What that will do is it will artificially increase asking prices, which is also something that will have an effect on the first-tier tribunals, where judges review comparable evidence, as there is no centralized database for rents achieved. They will only be able to use Rightmove, Zoopla, On the Market, and other portal reports, and where evidence can be gathered from properties let, they will consider that too, but tenants won't easily have access to that information, whereas agents will. Pet policies, another big change, and a bit of a misconception in the field. Many tenants are already coming to us saying, yes, but I have the right to keep a pet. That is not the case. The tenant will have the right to ask for permission to keep a pet, and the landlord will still be able to refuse, subject to valid reasons. For example, a head lease in a block of flats that prohibits certain pets. So provided there is a reasonable justification for refusing a pet, that will still be allowed, but a blanket ban on no pets is now prohibited. Sorry, when I say now, I mean when the bill becomes law. Anti-discrimination measures, in a similar way to how landlords cannot discriminate based on protected characteristics, whether it's race, religion, and so forth, you will not be able to discriminate based on where the tenant's income comes from, provided it's legal. So a tenant claiming benefits, whether it's disability, housing benefit, and so forth, you cannot advertise no DSS, for example, practice that I haven't seen for a long time, but I know that some parts of the country still have those adverts, which is going to be outlawed. It will be perfectly reasonable to refuse a tenant who cannot afford the rent based on affordability checks, in the same way as you can refuse a tenant who has a bad landlord reference or has county court judgments or bankruptcies or poor credit history. So again, nothing overly concerning here, but just a change of practice. And the main thing is that we need to look at how we've been operating up until now and review the processes. So compliance and enforcement is going to change quite significantly. Local authorities will be tasked with enforcement powers, and they will have an absolute duty to enforce those. So if they receive a complaint from a tenant, they won't be able to brush it under the carpet. They will have to investigate and enforce all housing related breaches. There will be severe financial repercussions for non-compliance, like rent repayments. Rent repayment orders can force a landlord to repay a tenant up to 12 months rent. And this is one of the ways that the local authorities tend to incentivize tenants to cooperate with them and provide evidence against their landlord. The most common breaches are licensing rules, so property being let without a license where a license is required, and then after the bill becomes law. This will also be one of those main breaches that the tenants will be incentivized to cooperate with local authorities to bring their landlords to account. So in addition to that, orders and enforcement action for breaches. I'm not going to cover it in too much detail now because I'm hoping that everybody on this webinar doesn't intend to deliberately break the law. This isn't intended for that. So at Martin Jarrett, we ensure landlords remain compliant, and we do that by a initial compliance audit, making sure that the property is compliant, all the certificates are in place, and that we start with the right foundations. Then the agreements, we're already amending our agreements and working on how the new landscape will look after the bill becomes law, so that we're one step ahead and that there's no panic at the last second. Managing pet requests will be also quite an important thing. As I said, you can refuse the requests, but you need to have a very valid reason for that. And from my experience, actually, tenants with pets tend to look after the properties very well. They make it their home and they tend to stay longer. So I don't think having a pet in a property is necessarily a bad thing, as long as you protect the property from damage. And the Tenant Fees Ban, the Tenant Fees Act, will be amended slightly to allow landlords to recover the additional costs in getting pet insurance as a result of that change. Of course, proactive marketing, rent reviews, and dispute prevention and resolution is something we already do, but the rent review piece will become more important as we enter into the new regime, with Section 13 notices needing to be served every 12 months and preparing the case for first-tier tribunals if there is no agreement reached. This is something that we're happy to do for you as part of our fully managed service, and we can discuss what else we can do that's relevant to landlords. So please get your questions ready for the end of this session. And in conclusion, the Renters' Rights Bill introduces huge reform, but it's not the end of the world, certainly not the end of the PRS. It will change things. A certain number of landlords will exit, some who have been thinking about exiting. This may be that push for them to do so, but the ones who stay will benefit from higher rents, because supply and demand dynamics dictate that when there is less supply and more demand, and I think demand will always be here, rents will increase. So the return on investment will improve over time. And the value in an estate agent and managing agents, not just sort of sticking an advert on Rightmove and Zoopla. It's about all of this. It's about doing the research, having the knowledge, and be ready to provide expert advice to your clients. So I know that on this webinar, we've got quite a lot of people who are not Martin Jarrett clients, although some already are. Please don't be shy. Reach out to me. I'd be very happy to have a free, no obligation consultation on your plans and tailor make a package that suits you best, even if it means just providing some advice initially. So thank you very much. And I suppose I will hand over to Mitch, who'll give you a tax update. So, Mitch.
Yeah, thanks, Greg. Really useful insights there. And we're going from the renters' rights to taxation. So hopefully we keep everyone invigorated and excited on this next part of today's webinar. My session will last around 15 minutes, so you don't have too long to hold on to towards the end where we get to the Q&A. Of course, as Greg mentioned, if you do have any questions in relation to taxation, please feel free to put them in the chat box or the Q&A section as well. So just as a brief introduction, my name is Mitch Young. I co-founded my company, which is called the Fusion Consulting Group. I'm best known for my work online, the largest UK tax influencer as Mitch the Taxman. For those who are that way inclined, you can follow me for tax tips, tax news across social media platforms. Multi-award winning tax advisor. Okay, so in terms of property tax, I'm just going to give a general snapshot of where we are, obviously some rate changes, and then generally what we're seeing in practice in what landlords are doing at the moment. So it still is a difficult place for landlords to operate within the UK tax framework. There's more tax rises on the agenda, and I'll cover those on the next slide in terms of the April 2025 changes. We also have a spring statement coming up in a few weeks. So whilst usually what happens is that the budget in November time gets enacted around this time, Rachel Reeves is rumoured to be looking at some subtle changes. So keep your eyes out for that. As Greg mentions, the regulatory changes as well is making it tremendously difficult. And of course, we still got Section 24 in operation, which means a lot of landlords are looking at their structuring. But over and above that as well, inheritance tax is changing, which I'll come on to in one slide, which is affecting farmers, farmland, but more importantly for this webinar, business property owners. So people who have maintained their businesses. And when we talk about businesses, we can talk about, of course, buy-to-let investments through a family company. So the major tax changes which are coming in April does affect capital gains tax and stamp duty. We're seeing a rise of the standard rates of capital gains tax increase, but also we're seeing changes to some capital gains tax reliefs as well. Residential property, when you sell your residential property, those taxes in terms of capital gains tax are going to be at 18% to the basic rate band, which is up to £50,000, and then above that 24%. We're seeing changes in what's called business asset disposal relief. So very briefly, what that means, if you've sold a business, if you've sold an asset, you have £1 million, which essentially can qualify for business asset disposal relief, where you're taxed at a lower tax in terms of capital gains tax. This previously was 10%. This is going to rise to 14%. We are also seeing some changes to stamp duty. There was a temporary threshold which was put in for first-time buyers as well. But essentially, we're seeing the stamp duty thresholds drop so that you'll pay stamp duty on from £125,000. And then it goes back to what was the previous stamp duty figures. So from £125,000 to 500,000. From 125,000 to 250,000, stamp duty 2%, 250,000 to 925,000, 5%, 925,000 to 1.5 million, 10%, and above 1.5 million, 12%. And then, of course, you've got the additional stamp duty to pay if you're purchasing another property. So that's what we're seeing in terms of the major tax changes. And obviously, as mentioned, the first time buyer relief thresholds have been decreased as well. So it is expensive to purchase property still, to purchase additional property, which is why you have to continue to work the numbers to find good opportunities, obviously working with Greg and Martin Gerard to source them out as well. So what are landlords doing? What are we seeing in practice where landlords are still subject to higher tax on their rents? What we're actually seeing in practice is landlords seeing if they can reorganize their structures. What this means is that if you're holding a lot of property in your individual name, then they're exploring opportunities to see if they can move that into, say, a limited company. That still is a common theme with landlords. Of course, it is a bit of a minefield in terms of navigating your way through that exercise, because moving properties from your own name to a limited company does create taxes, capital gains tax, stamp duty. But of course, once it's in a limited company, the benefits of doing that is that if you're going to hold the assets still for the long term, then you can offset the mortgage interest, you can pay tax on your true profitability at the corporation tax rates of 25%, and that for a lot of people is more palatable. But to get them into the property to company is a bit of a journey. So we need to crunch the numbers. We need to work out, are there any solutions? Are there any tax reliefs? And there are certain types of tax reliefs in terms of capital gains tax reliefs, incorporation relief, stamp duty, land tax reliefs if you're incorporating a partnership for commercial reasons. But each and every scenario needs to be looked at on their own merit. There's not this one-stop solution for structuring. It is a highly intricate exercise where each and every landlord, if they do want to look at tax planning and tax structuring, will need to go through. Now, in the short-term, medium, long-term effects, we are seeing a lot of partnerships being formed. Partnerships, essentially, they're just two individuals form up legal partnerships, and then the benefit of doing that is in the longer term potentially to shelter that stamp duty land tax relief. Doesn't have a huge effect on the actual income tax, but of course some basic tax planning could be if you hold the properties yourself and you're married or have a civil partner, and that and your partner is in a lower tax threshold or may not be working, then you may want to consider utilizing them so you can spread out the amount of tax you pay at the basic rate of taxation. So we've spoken about capital gains tax. We are seeing, some landlords actually want to exit the market. So looking at potentially selling their properties, of course, capital gains tax will be paid on the profits if you sell your property at the rates we've been through before, that 18 or 24% depending. I do have a lot of queries that come in about principal private residence relief. So I just wanted to touch on this briefly and just explain the general concept. So there is some common misconception that if you name one property as your main residence, then regardless of where you've lived in it throughout the period of ownership, it will be exempt when you sell the property. This is actually incorrect. So what HMRC do is they look at the timeline of ownership. And then, depending on the history of the timeline of ownership, they apportion the gain. So let's take a really simple example. Let's say you've owned a property for 10 years. You lived in that property for 5 years, and then you rented it out for 5 years. What would happen in terms of that main residence relief is that you calculate the gain. So what you sold it for less what you bought it for, that would give you a gain. Then you would apply the main residence relief. The main residence relief will essentially be 5 years in which you lived there over the 10 years of ownership times the gain, and that amount would be deducted from the gain. So essentially in that example, you'd get 50% tax relief. 50% of the gain would be subject to tax. So, you know, I felt that was an important point just to clarify if you are thinking about selling any properties that have been rented previously. You do, of course, have additional compliance as well, 60 days from the date of the sale, in order to submit an additional capital gains tax return. Obviously, the majority of people on this webinar would be used to submitting their annual self-assessment tax return. When you sell a second property, and if you've made a gain, you now need to submit a capital gains tax return, pay the tax as well. So just bear that in mind from a compliance perspective, because otherwise, guess what? HMRC are going to fine you for failing to submit the capital gains tax return, much like if you fail to submit a self-assessment tax return, £100 automatic penalty, £300 the next 3 months, and so on and so forth. So a lot of our clients are concerned now around inheritance tax. And again, this comes down to how are you owning your property? Obviously, a lot of landlords are concerned generally with their profitability on a month-by-month basis, year-by-year basis, their exposure to tax, short-term tax, of course, income tax. But ultimately, there comes a point where you've built up properties as an asset class, and as we know, on death, those assets will be subject to inheritance tax. If your total estate is above the nil rate band, £325,000. If you're married, then potentially you can have 2 lots of nil rate bands. And if you leave your main home, it could potentially go up to £1 million. But over and above that, your estate would be subject to 40% inheritance tax. So a lot of our clients are concerned about that and looking at ways to potentially, can they gift their properties? Can they gift their property to their children? What is the tax position? And of course, there is tax to pay. When you gift something to someone, unless it's your spouse or civil partner, there is always a change of ownership. So there's generally capital gains tax to pay if there's profit on that gift. The tax treatment on a gift would be what you originally paid for the property less the market value at the date of the gift, subject to capital gains tax. Potentially there could be trust works involved. A lot of our clients are interested in trust. If you gift something to a trust, then it will sit outside your estate, protects the family bloodline. But of course, trusts have a whole mechanic of taxes that one needs to consider. But interestingly, a gift to a trust doesn't attract capital gains tax. You can claim holdover relief, but depending on the value of the property going into trust, there could be an immediate charge to inheritance tax called a chargeable lifetime transfer. If you've built up a company, so I've had loads of clients come into me recently, they've got a mix of commercial units and residential units, and they say, oh, well, we don't have to worry about inheritance tax because all my assets are owned within a limited company. Now, this is incorrect. Very broadly, what the government have now done is that there's something called business property relief, which essentially means if you have a trading company, on your death, the shares, the market value of those shares of those company qualify for 100% tax relief. So if you've got a company, shares are worth 10 million, previously it would qualify if it's trading for £10 million worth of inheritance tax relief. Now the government said you can only get £1 million capped at 100% business property relief. Anything above that amount in terms of shares, the value of the shares would be subject to inheritance tax at essentially a reduced rate at 20%. You get 50% business property relief. So it's a net tax of 20%. Another change to taxes has been the abolition of the furnished holiday let regime, a very popular regime for landlords and property investors over many years. Essentially, what this allowed you to do is to purchase short-term lets, like a holiday home, and it came with some attractive tax treatment. Essentially, what it was is that if you had a property which qualified as a furnished holiday let, ideally, short-term lets, then you were able to treat these properties like a business. So you were still able to offset interest. When you sold the property, you could benefit from the business asset disposal relief, reduced capital gains tax, as mentioned earlier. But from April 2025, this regime will be abolished, and the furnished holiday lets will be taxed like your typical buy-to-let investment. I'm sorry, I'm not giving much positivity here at the moment. So the point with that really is that if you do have furnished holiday lets within your portfolio, obviously ensure that you're prepared for that additional tax of what you're going to be suffering over the next coming period. And really, there's no great solution in terms of mitigating taxes. What one needs to really do is to sit with their tax advisor or accountant, but typically a tax advisor will do that layering of work, future planning, forward thinking about the different options of what you can do, what's going to make you the most tax efficient now and with one eye on the future. Some people are just concerned about the income tax side of things and won't be as concerned with the inheritance tax side of things. But it's about modeling out, and there are solutions in terms of if you can get your properties within some type of structures, that may work better for you in terms of the flexibility, the cash flow, and give you a better return on investment. The tricky part is getting there, and that's where you're going to essentially need the support of a professional. There is a distinct difference between an accountant and a tax advisor. The accountant will generally do your crunching, looking back over the past year. The tax advisor will sit down with you, forward plan, model out the short, medium, long term areas of taxes, and then collectively you can make a decision. Just bear in mind, obviously, tax is only one element of the decision making. If you have debt and lending, if we are going to reorganize anything into different people's names, then we need to assess the finance implications as well, of course. So thank you very much for listening. I'm going to hand back to Greg to conduct the Q&A session.
Thanks, Mitch. That was excellent. In fact, whilst it's fresh, I've got a question from someone regarding the private residence relief. So you've mentioned that over the 10 years, if somebody's lived there for 5 years, it'll be apportioned 50%. Now, what happens if the main capital gain occurred during the time when they were resident in the property? Is that taken into account, or is it a simple sort of percentage divide?
No, I mean, it would just be in the year of the sale, the capital gains tax will be applicable to whenever the sale happens. So it's not like if the gain related to a period 3 or 4 years ago, you could then utilize that capital gain figure. Unfortunately, it would just be whatever the gain is it will be at the rate of that tax year.
Okay, thank you very much. I've got quite a few questions coming through on the renters' rights. We'll start with Claire. So the question is, our current tenant is moving out this March, so we can use the property ourselves for the next few months while our own house is refurbished. After that, we plan to rent it out to our goddaughter at a very reduced rent so that they can save up to buy their own property under the Renters' Rights Bill. Would this now mean that if they choose to stay for a number of years, that we would be unable to ever raise their rent by more than inflation? I don't believe that to be the case. I think that provided it's an arm's length transaction and you're declaring it and you're paying taxes on the income and things like that, the first tier tribunal case would look at it and give you an opportunity to adjust the rent in line with market rates. So because you're starting off at a considerably lower figure, the potential to increase rent will be there. The question is, would you want to do that formally, or are you better off negotiating that through serving Section 13 notice and then negotiating a slightly lower rent, document that in writing? I say the second would be a better option. But again, I'm very happy to provide sort of some more specific advice. Stephen is asking, serving notice, ground 1A1 cannot relet for 12 months. How will this be policed? This is going to affect so many landlords who try to sell but are unsuccessful and they need to relet it. Absolutely right, Stephen. So yes, that is there to prevent landlords getting rid of tenants through the back door and essentially pretending that they're putting the property on the market to sell when in fact they just want to get the tenant out and get more rent. It'll be policed by local authorities. The tenants will be incentivized to keep an eye on the property going back on the market. Agents will have a duty to ask you a question whether the property was let. There will be mechanisms of the local authorities checking the council tax bills and many, many others. So it's definitely not worth trying to bypass the system or find a loophole. Ultimately, do your due diligence. Don't blindly believe the valuations that you're being presented from the sales side. Ask for comparable evidence, because if you don't get it right and you don't sell, you have a risk of having the property vacant for 12 months, and that's a very, very costly mistake. So no simple answer, but not worth trying to get around that system. I can provide more information afterwards if you wish. If you really were in a position where you wanted to test the waters but didn't want to go through this sort of risky process of Section 8 notice being served, I would probably come to an agreement with the tenant unofficially, where the tenant gives up possession or gives you notice instead. But again, this is the sort of thing that we'll be able to advise you if you're one of our clients. Another one for Mitch. How much would you expect to pay a tax advisor to manage my journey of incorporation, my small property portfolio? Mitch?
Yeah, thank you, and good question. Essentially, different companies do it in different ways. We always like to produce a piece of tax advice first. So actually analysing what your tax and financial impact would be on incorporating the portfolio to make sure that that is the right decision for you. B, analysing whether you actually qualify for the variety of tax reliefs I mentioned, because it's not a simple exercise. So we essentially would charge a fixed fee for that process, depending on how many hours I felt that would be. And then from there, we would help project manage the incorporation, working alongside your existing accountant and solicitor, because the process does not just involve a tax advisor. It will involve the accountant, who will have to do the necessary entries. It will involve the solicitor, who will have to do all the legal documents in terms of maneuvering of the assets, and potentially it might involve your lender or mortgage advisor. So I'm happy to obviously discuss the process with you. If you want to get in touch with me, no problem at all.
Thank you, Mitch. I've got two more questions on renters' rights. Russell, hi, Russell. Nice to see you here. If there's a pre-agreed rent increase in an existing AST, i.e. rent increasing in year 2 of a 2-year AST, does this still stand, or will that pre-agreed rent increase be voided and a Section 13 be required? Simple answer is all rent review clauses in the current agreement will become unenforceable and void when the law becomes active, when it's implemented. So yes, the answer to your question, Section 13 will need to be required. You can serve it every 12 months, and there's a little bit more of an in-depth process. But as an existing client of Martin Jarrod, you'll know that we follow that process pretty much to a T already. So there won't be too much difference as far as your property is concerned. We'll be happy to guide you through that. Question from Jack. Hi, Jack. Can you rent the property on a very short-term basis, for example, Airbnb, during that 1-year notice period? Short answer is I don't know the exact answer, but from the look of it, I don't believe that that will be allowed because that goes against the spirit of the law. And bearing in mind that a tenant can move into a property, give 2 months notice at any point, how is that any different to an Airbnb? So not 100% seek your own legal advice, but my interpretation of it is that no, you are not allowed to relet on short term. Another one, if the tenant has moved out and the property is on the market for sale. Right, so the crucial difference there is, have you served a Section 8 notice, and are you intending to rely on ground 1 or 1A? If so, it is an offence to state a ground that you don't intend to rely on. And if you are intending to rely on, it does come with a period where you cannot relet a property, and that's 12 months after you gain possession. Also worth mentioning that you cannot use that ground within the first 12 months, but that's 12 months from the tenant initially moving in. So if you already have a tenant in the property and they've been there for 12 months, you can serve that notice at any point. Right, another question from Gordon. If landlord has granted a 2-year AST 1 year ago, can he serve a notice to quit for a sale purpose as soon as this new law comes into effect? So if the 2-month period for both tenant and landlord, or is the landlord still bound by the original? Sorry, I think I've inadvertently just answered that question. So you don't have to wait for another 12 months, provided the tenant has been there for 12, or actually 8, because the notice itself is 4 months. You can serve notice without having to wait. Got another question. I've heard some landlords are serving Section 21 notices now before they are abolished. Is this a good idea? The answer is depends. Why would you want to bring a tenancy to an end at this stage? If you are concerned that neither of the grounds are suitable for your case, then perhaps. But in reality, the question is, well, what sort of reason is that? And as I said in my presentation, I wouldn't be overly concerned about not being able to get possession back of the property. But if you've got a disagreement with your tenant currently and you think that you'd rather start afresh, then yes, you can use the Section 21 notice now. It is still valid. There will probably be a transition period of a couple of months for existing notices, existing Section 21 notices to be enforced whilst the law is being implemented. Remember that Section 21 notices have a lifespan of 6 months, which means you need to use it or lose it. I see there is another one from Steve. Is it 12 months plus 4 months notice, or notice from 8 months? Yes, notice from 4 months notice from 8 months. Okay, and I think there are a couple of questions that are doubling up, but I think that is pretty much it. So, Mitch, unless there are any questions that you've got in your inbox.
No, I'm good, thank you.
Fantastic. So thank you very much to everyone who joined us, and we hope that it's been useful. A recording of this will be sent to everyone who's registered. I've just seen a question pop up. Mitch, do you have sort of time for one more question?
Yeah, of course. Yeah.
So it's for you. Can you transfer or gift a property to children under the age of 18?
Yeah, I mean, you can is the answer. Obviously, from a tax perspective, there'd be a variety of different tax treatments. There's something called the settlement legislation, whereby that if the children are going to receive income, then depending on their ages, it will still be taxable on the parents. So you need to be a bit careful about that and knowing and the reasons as to why you're doing that. But from an income perspective, it's unlikely you'd achieve the desired results because of the settlement legislation.
Brilliant. Thank you very much for that, Mitch. And we've seen some good comments there. So thank you for your positive feedback. And it looks like it has been useful. Videos will be sent out to everyone. And watch out for our next webinar. So thank you very much. Have a great day. Mitch, thank you. And look forward to working with you again.
Yeah, thank you very much, everyone. Thanks, Greg.
Take care.